There's a reason I talk about starting to invest young so often. And it's not because I think you need to have a lot of money in your 20s. It's because time is one of the most powerful tools you have when it comes to building wealth. And the reason time is so powerful comes down to one thing, and that's compound growth. You probably heard people say that your money can make money. But what does that actually mean? How does, $10,000 turn into hundreds of thousands of dollars? And why does starting at 18 instead of, say, 30 years old make such a massive difference? Let me explain compound investing as simply as I can. Before I begin this video, as usual, this is not financial advice. I'm not a financial advisor. This is purely for educational purposes only. Let's start with the simplest possible example. So imagine you invest, let's say, $1,000. Let's say purely for illustration that your investment grows by 10% in a year. That means you make $100 on that original $1,000 investment, so now you have $1,100. Here's where compounding comes in. In the next year, or the following year, you're not earning 10% on your original $1,000. You're earning it on $1,100. So say, for example, if the market goes up another 10%, that would be $110. So now you have $1,210. Then the next year, you're earning 10% on 1,210. That's 121. Now you're at 1,331. So notice what's happening. So your returns are starting to generate their own returns, and that's what compound growth is. You're making money on the money that you've already made. And over long periods of time, that can become incredibly powerful, as I talk about all the time on this channel. So to understand why this actually matters, let's compare it to simple growth. So let's say if you had $1,000 and somehow earned a flat rate of $100 every year, you'd make, in year one, $100, year two, $100, year three, $100, and so on. And that's linear, right? But with compounding, your returns get added to the balance and future returns are calculated on that, larger balance. So your growth can start slow and then over time it accelerates. And that's why compound growth is often described as exponential. The early years can feel almost kind of boring, but later on the growth can become much more noticeable. And one thing I actually saw recently was that, say, for example, with this, Warren Buffett, his net worth as he got older just got blown out of the water. And that was because of compound growth. So think about it as like a snowball rolling down a hill. At the very beginning, it's small. You might not even notice much happening. But as that snowball rolls, it picks up more and more snow. And then that bigger snowball picks up even more snow because it's a bigger snowball. And eventually, that snowball is growing much faster than it was at the beginning. And that's basically what you're trying to do with your investments. You're kind of building a financial snowball. Your contributions make the snowball bigger, but over time, the returns can start making the snowball bigger as well. So it's not just your contributions working for you, it's your returns that you've made on those contributions also working for you. And eventually, those returns themselves can become a significant part of the growth. And this is why starting young is such a big deal. Let's say, two people both want to build wealth. Person A starts investing at 18, and person B starts when they're 30. Even if person B eventually invests much more money each month, person A has something person B can't get back. And what that is 12 extra years of compounding, and that's incredibly valuable, right? 12 years is a lot. You don't necessarily need to be rich at 18 years old. You don't need to invest thousands of dollars every month. You just need to get started. Because when you're young, your biggest advantage isn't necessarily the amount of money you have, right? Because you're not likely going to have a lot of money when you're super young. It's actually the amount of time your money has to potentially grow. So here's another really important concept. When you're starting out, most of the money in your account is probably going to come from you, right? Say you put in $100, you put in another 100, you put in another 100, and it can feel like you're doing all of the work. But as the account gets larger, something actually changes, right? The investment returns become larger because they're being calculated on a larger amount of money, right? So a 10% return on 1,000 is 100, but earning 10% on $100,000 is $10,000. Right? And earning 10% on $1 million is $100,000. It's the same percentage, it's just a completely different dollar amount. And that's why building the initial investment balance is so important. Right? Once you have a large amount of capital working for you, even relatively normal returns can translate into significant dollar amounts. Right? Say, for example, one year, you have $100,000 in the market and you get even just a 4% return. That's still $4,000 that you get for essentially doing nothing other than just having your money in the market. So let's use a hypothetical example. So say you're 18 years old and you invest, let's say $200 per month. So that's $2,400 a year. If you invested that money consistently for decades and earned an average annual return of, let's say, 10%, which is the historical average of the S&P 500, you'd potentially end up with a very significant amount of money. But here's the important disclaimer, right? 10% isn't guaranteed, right? The stock market doesn't give you 10% every year. You might have a year where you're up 20%, you might have a year where you're down 20%, and you might have years where the market is stagnant, right? And it barely moves. The 10% figure is just simply a hypothetical long-term assumption that a lot of people use when illustrating historical stock market returns, like I said, like the S&P 500. And actual results will vary, right? The point isn't that you will definitely earn 10% because we know that that's not the case. The point is what happens when you give your investments time to grow and time to compound. And this leads to another important part of compounding. Don't interrupt it unnecessarily. If your investments fall 20%, it can be so tempting to panic and sell them. But a market decline doesn't necessarily mean, your long-term investment plan has failed. It doesn't mean you've lost money. And I believe it was Warren Buffett who actually said, the market was really down at one point in time and people were asking about all the money he lost. And he said, I haven't lost money yet. I haven't sold my positions, right? And that's the case. If you're still contributing money, lower prices can actually mean you're buying more shares with each dollar. And that's why I think long-term investing is so important. You have to be able to tolerate the ups and downs because, compounding doesn't happen in a straight line. As much as some people wish it did, it does not. Your account is going to go up, it's going to go down. There'll be crashes, recessions, good years, terrible years. But, the goal is to stay invested long enough for the compounding process to actually have time to work. So if you want to remember one thing from this video, remember these three ingredients. 1 is money. 2 is time, and 3 is consistency. You need money invested for compounding to happen, obviously. You need time for the returns to build on themselves. And you need consistency to help you continue adding to that snowball like we talked about earlier. And the earlier you start, of course, the more time you have. And that's why I think one of the biggest financial advantages you can give yourself in your 20s isn't finding this perfect, golden, magical investment. It's simply just starting. Compound investing isn't magic. It's not a get-rich-quick scheme, and, it's definitely, as we talked about, not guaranteed. It's simply, what can happen when you invest money, leave it invested, and actually give it enough time to potentially grow. As we said, at the beginning, the numbers might look small, but decades later, those small contributions can potentially become something much larger. So if you're young and watching this thinking, I don't have enough money to start investing, start with what you can. You don't need to become wealthy today, as much as everyone would love to become instantly wealthy, right? You need to give your future self as much time as possible. Because the earlier you start the snowball rolling, the longer it has to grow and the bigger it will get. The easier it becomes. The more time you give it, the more contributions you give it, and the earlier you start. So that's my quick crash course on compound investing. Hopefully you were able to take something from this video. If you enjoy this type of content, please feel free to subscribe. Thank you for watching, and I'll see you in the next video.